Welcome back. Today I'm going to talk to you about a good subject over finance. We're going to talk about mutual funds. Let's get right into it. So what is a mutual fund? On Investopedia, a mutual fund is a type of financial vehicle made of a pool of money collected from many investors to invest securities such as stocks, bonds, money market instruments, or other assets. Mutual funds are operated by professional money managers who allocate funds to other funds' assets and attempt to produce capital gains or income for fund investors. A mutual fund portfolio is structured and maintained to match the investment objective states in its prospectus. So, key takeaways. A mutual fund is a type of investment vehicle consisting of portfolios of many stocks. So just overall, what a mutual fund is, just to, in my opinion, and overall, is a collection of stocks. And just for example, I'm going Fidelity. Right now, I'm heavily invested in FNSTX, Fidelity Infrastructure Fund, because of Biden's new bill, infrastructure bill, three to I think it's $2 to $3 trillion bill. I invested heavily in the mutual fund. So when picking out a fund, you have to see if there's no transaction fee. And funds usually hold their value more than stocks because over time stocks do go down, and funds they usually hold their value really well. So for example, I invested about 45,000. I got about 8,000 in return. That's about like almost 19% return right there. So and when you see this thing on Fidelity, I choose Fidelity because they have low cost, and you can see their performance as of today, since the inception. So 1 year return right now is 12%, and 20% is not that bad, and it compounds every year. So what compound with compound returns every year, you get increase in percentage. Um, my best advice is to invest in mutual funds, since then you can see their portfolio top holdings. Next Energy, Inbridge, and you can click on them too to see what what is Inbridge. See, like, you click on them, you see Next Energy is a big company. They're let's see what they're from. So you just kind of research each one. Takes a more less work. See, they're a energy company, about 46 gigawatts of electricity generating capacity, revenues 72 billion. So these are good companies. They're all packed in one fund. So I do feel like investing in funds are safer. And just to show you one stock that I lost money in, the SPAC, him stock. It's up today, but you can see the 1 year chart. It's steadily decreasing. That those are the dangers of SPACs, special acquisition companies. If you put a lot of money in SPACs, I feel like because since they're still young, they're burning a lot of cash. Like even with these are like venture capitalist companies, like Tesla or even HIMS. We're overvaluing what they can overproduce. So so I also want to show this type this program software is called Y charts. I really recommend using Y charts when finding stocks. I have been doing fairly decently now because I'm using Y charts. I'm using the free trial, but they have it takes the guesswork out of trying to find, it's $200 per month, but it takes the guesswork out of trying to find this right stock, and you can make much more money. So just an example, I invested in TPX, Temper Sealy, which is show you the company. They do, beds, Tempur-Pedic beds. They're the world leading largest bedding provider, and company develops, manufactures adjustable bases, pillows, sleep and relaxation products. And they have Sealy, Tempur-Pedic. These are their brands, and you have to buy in something that you know, and let's see why I'll just show you how to use it. So this little area right here is really good because you can see the fundamental score. They don't give it because it's insufficient data, but the fundamental score is really well, 8 out of 10. Valuation, they're undervaluated, so right now that's a 27% increase valuation. So PE ratio is about 48. You know, you want a low PE, but that's the PE is that much. Um, price share, earnings per share times that. That's a PE valuation. Price sales, you know, prices sales multiples are attractive valuation. Sales figure tend to be stable than earnings. This means the valuation fluctuate less than year to year. PS multiple than PE multiple. Look, skills still will be skeptical of valuation of company experience instead of recent growth. So PS is, let's see, price to sales valuation score. Price to sales valuation stocks applying the historical average of the median price sales ratios current trailing 12 months sales numbers. So you just have to make sure that let's see. So this PE ratio, they get that PE ratio over average over 3 years times the sales per share, and that's the PS valuation and historical valuation. So that's how they get that $50 mark. The PE plus the price to sales number, then that plus that, and then equals that. The divided by number of valuations is 2, and they get that number. So that's how they figured out that valuation score. So let's see. So you have to be investing. You have to kind of use math too. And why I invested in this company, you can see over year to year, they have consistent returns. You know, but you have to look at the last 4 years, how they're doing the last 4 years. So the last 4 years, they are increasing their number of sales or number of revenue. So they're really profitable. Um, and net income, increase from 100 million to almost 200 million to, the 348 million right there. And you can see how many diluted, shares data. Their average basic shares outstanding stayed fairly up and down. But let's look at the balance sheet. Okay, let's see, assets. So these are all the assets. And if anybody would know what are assets are cash, accounts receivable, inventory, expenses, property, machines, gross, um, intangible assets, long-term deferred assets. These are all assets. Cash, property, goods, raw material. So all of their assets, they have $3 billion in assets, and they're increasing in assets. So that's good. Good sign. Let's look at their liabilities. So account payable mean like something they have to pay back. Um, taxes, accrued expenses, long-term debt right here, liabilities, and long-term liabilities. So assets or liabilities, check mark. They're over that the liabilities. And shareholders equity, you know. Okay, let's see how much cash flow they have. So net income increased, check mark. That's good. Uh, let's look at the cash flow for investing. No, we don't need that. That's not ending cash. So let's see there anything else. So what's important actually is the net income from when you're looking at cash flow. Are they increasing their net income? And you can see there's a big increase there. So uh, I do feel like this software is very helpful, even though it's expensive. Now it's very helpful software. And another stock that I found that it could be, 2x, um, is it takes the guesswork out of just trying to figure out companies that are doing well. Like Neo. You can see Neo. I can show you Neo company. They give a void, so because weak, and you can see their gross profit margins and financials. Um, revenue. The revenue is increasing. That's good. That's good from 1 billion to 2 billion. But you can see what's happening with them. The assets. Let's see our assets or liabilities. That's good. Asset or liabilities still good. Cash flow. So they're still ending with negative cash flow. So that means they're still not making money. So I don't think Neo's a good investment actually. You can see their fundamental score is weak, and you can see they don't have enough data to support, so they don't show valuation right here. So their profit quarterly is okay, but overall they're negative 20% growth. Net income in trailing 10 months they're still a negative 800 million, about 800 million. So, and let's do everybody's favorite Tesla. Thank you for sticking around. If you stick around, you find a really good stock that I found. So right now, the valuation score for Tesla is a 2. Woo! It's really bad. They do have a net income of 690 million, revenue 45% year to quarterly. That's pretty good. Uh, let's see, they have earnings coming out this month. Probably, maybe do good. Okay, let's see. Um, revenue's increasing. That's good. Balance sheet. Cash. Ooh. Assets. Total current assets over liabilities. Uh, yeah, they're good. They're good with that. 52 billion in assets over 29 billion in liabilities. So check mark. So net income. So you can see over the trailing from 2011, they're negative 254 million. You know, they've been just doing negatives, and then there's almost a negative billion, a million, 1 billion right there. But this year, boom, over 100% in sales, $862 million in sales. So they are profitable this year. From last year, they weren't really, they were really not profitable. So we're evaluating this. I'm just evaluating you through the Y charts, and they're just showing that it's up to you to invest in a company, but it's right now it's overvalued. So this is a good company it's called Catalyst Pharmaceuticals, and they have a valuation score of 5, which is average, but show the analysts have price target of $7 here. So that's a double. That's a double. $7 to $8. That's an increase. Um, you know, you can just easily double your money. Um, what's kind of good about them is like you can see the revenues increase. Year to year growth 2%, but look at that quarterly gross profit margin 84.3%, profit margin quarterly 36.88%. Okay, and I don't really know what this company does, but I think they just cast biopharma. Uh, Rare disease diagnosis can be extremely difficult. Just isolate and hopeless. That's why we believe when you're battling rare disease, it's all about the company you keep. Okay, they're wanting to um, help with rare diseases and cutting edge science breakthrough. And they have a I think they have a new FDA approved for Lambert-Eaton syndrome. This FDA approved, so that's really good, and it's a beautiful website. Okay, I just want to show you their finances. You have to look when you're investing in companies. You have to look at their finances. If you don't, you will always lose. So, from look, they've just been investing, but now that they have actual FDA approved, um, you know, FDA approved product, you could see, they're having revenues now, 100 million last year to 119 million this year. This could be a big company one day, and the net income increased. From they've been posting negatives, and then now they've been posting really 30 million, 74 million, maybe 100 million next. Who knows? I think it'll be 100 million. So assets 192 million over 22 million. Wow, they have a lot of assets. This is a good. This is a positive company right here. Net income. Wow, look at that. 74 million. 74 million. It's good. It's a good company. Could they keep? Could they keep going? I think they will surpass that number, and they'll definitely keep going. But uh, just look at this software. It's very helpful. You don't have to take the guesswork out of trying to figure out and losing money. Like I lost a lot of money in HIMS. I do feel like their company is changing since they're moving towards more gear more towards sexual health and all these things. But I don't feel like they are going to increase. But they could be down 5 to 10 years, right? So no. Thank you. Goodbye.